Well, hello again. Today we're going to be talking about an exciting subject. If you couldn't tell, we're going to be talking about retirement and different types of retirement accounts based upon what you probably see on the screen. So, I am excited to talk about this. I know this has been a theme lately, and been a theme because I am just on fire right now with writing annuities. I've written 1.2 million so far. I've got some other ones in the works as well. So, there's just so much opportunity in this, and I would just want to let you guys know what I'm doing so that way you can have some success as well. Number one is that annuities help people. It protects their money from stock market loss. When the market goes up, then they lock in the interest. I had some clients that locked in over 25% this last year, tracking some different indexes. And so, that doesn't happen every year, but it's nice when it does happen. I always say maybe more long term, you're probably going to be looking at, somewhere 7, 8%. That's probably more realistic long term, but it's nice when you get those big years. And the best thing about it is there's no fees. So I'm going to go over a couple of different types of retirement accounts so that way you guys are familiar with it. So when you start talking the language, it's nice to know a little bit about things, right? And so the other thing is, if you're like, gosh, I would like to get some annuity sales, and again, these are going to be get your big pops of cash, which is really nice to have. Okay, so there's a way. If you're not confident with it, you can just learn something real simple. Just say, you're having a conversation. Hey, you know how the stock market's goes up and down, and of course, lately, depending on when you watch this video, right? But lately, the stock market last couple of weeks has gone down. So anybody that has a retirement account, their accounts are going down. So that's why I say start the conversation with, hey, you know how the stock market goes up and down? Lately, it's been going down a whole lot. Yeah, oh yeah. Well, how do you are you familiar with the types of accounts that you can protect your money from market loss? So when the stock market goes down, you don't lose anything. But the market goes up, you can lock in the upside and without paying a fee. Oh, you're not familiar with those? Okay, well then you need to talk to our expert or my guy or whatever you want to call me. You need to talk to Joel, and he's great. He knows what he's doing. Blah blah blah. And what he does is he'll ask you some questions, or maybe you can gather the information, right? And then basically he'll make a recommendation to you, and then he'll explain how it all works. And so you could basically, you could just schedule appointments for me, and I easily recommend, if you've never sold an annuity before, that's what I would do. When I first started, I would schedule appointments for someone else to come with me until I could get comfortable with them. Now, when I first started annuities, they were a lot harder to explain. They weren't as good as they are now. And of course, now I think they're a lot easier, or just because I've been doing this a long enough time now. And so I know the language, right? And so when you first start, doing these, the first two, three, five, whichever you need me there, what we'll do is we'll split the case. And so that way you can learn from me and get paid as well. And then when you feel like you want to do this on your own, do it on your own. But this way I can help you have success for sure. And so, but with that being said, let's go into IRAs. Okay. So let me flip over here for just a minute. So let's find this screen here. Here we go. Okay. So I'm going to scroll down here, and it says types of IRAs: traditional IRAs, Roth IRAs, payroll deduction IRAs, SEP, uh, simplified employer pension is what a SEP is, just so that you know. Let's see here, simple IRAs, SARSEP. And so these are some different IRAs. Now, today we're really going to talk about traditional, Roth, SEP, and simple. Okay. Now, a couple things. I want to click on here where it says traditional. And what is a traditional IRA? Well, it's an individual retirement account. An individual can do it. It cannot be joint. Like a bank account, which is a non-qualified account, can be joint. Individual retirement account cannot be joint. Okay, or can a Roth, just so that you're aware. And so there are some benefits. Okay, what are the benefits? Well, IRA, Roth IRA, SEP, Simple, these are all considered qualified plans. So is a 401k, a qualified plan. What is a qualified plan? It has special tax treatment. So for example, when you put your money in, it grows deferred, okay? And as long as it stays in there until 59 and a half, you don't get any federal tax penalty. If you pull it out prior to 59 and a half, you're going to get a 10% federal tax penalty. So an IRA will grow deferred, but for example, what happens is with most people will have like an IRA from maybe an old 401k where they put their money into it, and then basically, their money went into it from their checks. The taxes were never paid on it. So whenever they pull the money out, that is when they're going to pay the taxes. Okay. And so, or sometimes people can start them up after the fact where, the taxes haven't been paid on it. It just grows deferred. And then when they take the money out, they pay the taxes. So that is a traditional IRA. Now, the difference with a Roth IRA is a Roth IRA is going to be you've been paid from your income, okay, or if you're working for someone, you got paid on your check, and then what you do is you put the money into a Roth, and then all the interest on that Roth will go 100% tax free. So as long as it stays in there till 59 and a half, when you pull the money out, there's no taxes on any of the growth, which is pretty awesome. Now, of course, on a Roth, if you're less than 5 years away from 59 and a half, or if you start one up after 59 and a half, the money will have to be in the Roth for at least 5 years to avoid the 10% federal tax penalty. So just to kind of give you a little idea on these. So now the another thing people ask, well, what are the contributions? See, the great thing, and what I'm looking at right here is just the IRS's website. So you can get all the definitions from the IRS's website. I don't show it in this video, but I typed in IRA and then irs.gov came up, and then you click on it and it goes to the retirement accounts. That's how I've basically learned about the different requirements and limitations on these products. So for example, right here, you can see, just one second here. Okay. You can see the limitations. So for example, this shows here for 2024. Okay. And by the way, the limitations on the Roth and the traditional IRA are the same. Okay. So, and this says 2024 because you can still contribute to the 2024 tax year up until April 15th of this year. So that's why it's still showing 2024. I'm assuming that after April 15th, it'll change to 2025. And sometimes there are different limitations each year. So if you go back here and you look, it'll show you 20, or even down here, 22, 21, 2019, it was 6,000 was a limit per year. 23 it was 6,500. And then of course, last year for a Roth or a traditional IRA, the limitation was 7,000 a year up to age 50. And then once you hit age 50, you can put up to 8,000 a year. So that's a limit. Now, if you put more in that, you're going to get a penalty. Okay. So basically what happens is in the year, you'll have a statement that goes out. It'll show what you contributed, it's filing your taxes, and you'll get a pretty hefty fine. So you want to make sure you stay under those limits. But those are the two simple things about Roth and about a traditional IRA. Okay. Now I want to talk a little bit about a SEP account. Okay. So a SEP is a simplified employee pension plan. And again, I'm not going to go to all the details. I'm going to give you the basics. Okay. The basic concept is simplified employee pension. So this is really set up for, a business owner. So a lot of times like an individual business owner or a business owner that has a few partners, this is perfect for them. Okay. Now, if they have some employees and they set one of these up, whatever they're going to put into it themselves, they have to match their employee as well. Okay. And so there are limitations and how much they can put into it. So let me see if I can find those. Okay. There we go. Okay. So it shows right here, 2024. Basically, they can put up to 25% of their income. And of course, it shows here, it says, employee. And then also, basically, or if their income if their 25% would be higher than 69,000, they can't put more than 69,000 in. And so that is the limitations. And so, basically, if they're going to put 25,000 into their own, or 25% into their own account, they have to do it for their employees. So they may not want to do that. So they might want to do a little bit lower, but those are the pros and cons of a SEP. And so otherwise they can put up to 69,000. That's the max for the year. And so that is, like I said, again, this is more for individual and self-employed. Okay. And so, sorry, I've got some distractions going on here. So anyways, The next thing I'm going to go over is a simple IRA plan. Okay. And a simple IRA plan, this is going to be more for companies. All right. So this is going to be a small business, generally with 100 or fewer employees. Okay. And by the way, one thing I didn't talk about on the SEP is there is a form. Okay. Just like right here, it says Form 5304, there's one for SEP as well. They have to fill that out. So when you do one of these, and we'll typically use National Life Group, they can set up a group plan. We'll have to get this form. It have to be turned in as a requirement with the application. And so, of course, it'll just be reported to the IRS. So that way, they get all the proper documentation. And then I believe they have to, on their part, not on our part, they have to have some type of plan that they're going to offer this to their employees. And so they have to have something in writing showing that they're going to offer a plan. And so down here, it's going to show right here, it says matching contribution up to 3% of the compensation. So they have a couple options. Okay, so it says, sorry, I got ahead of myself. Employer is required to contribute each year either a matching contribution up to 3% of the compensation or 2% non-elective contributions for each eligible employee. Okay, so this is how this plan works. So these are some neat things. And what I would say is that as you get into your retirement, you were talking to people, what's going to happen is some of those people might have a business. And then it's good to know about these different plans. Think about plans for individual business owners is SEP. Think about plans for businesses that have employees is simple IRA. Okay. So that's really the two you need to be concentrating when it comes to businesses. Otherwise, just know that what an IRA is, what a Roth IRA is, be able to talk about that. The other thing that is not listed here is what they call a non-qualified plan. So what a non-qualified plan, it's like a bank account, for example. It doesn't have any special tax treatments. So typically, or like a stock, typically at the end of the year, if you made interest, you'll get something that shows the interest that you made, and that interest is taxable. Well, with an annuity, it actually does have a little bit of special tax treatment for a non-qualified plan. Number one is there's no limitations on a non-qualified plan. So if somebody wants to dump in $100,000, they could do it, right? The other thing is that in an annuity, a non-qualified plan will grow tax deferred. So whenever they pull that money out, that's when they pay the taxes on it. Now, if they're younger than 59 and a half, the 10% federal tax penalty does apply. That shocked me when I heard about them. Like, this doesn't make sense as a non-qualified plan. Well, it does, probably because they allow it in an annuity. So the cool thing about an annuity is if you have somebody older that's basically they're just like going to pass the money on, well, they can put it into an annuity and grow it and never pay a dime on any of the interest earned because they can defer those taxes for the rest of their lives until death. So then it would pass on to their beneficiaries. So I hope this helps you. And again, if you are, I just want y'all to get familiar with different types of retirement plans. And of course, we can put every one of these IRAs, Roth IRAs, SEP, simple, all inside of an indexed annuity that has the downside protection with the upside potential. And remember, just when you're out there talking to people, hey, have you heard of, how the market's been going down? Well, have you heard of a plan where you can actually get your money protected from stock market loss? When the market goes up, you can lock in interest and there's not even a fee. You haven't? Okay, well, you need to talk with my guy, Joel. He's awesome. Basically, he'll show you exactly how this works and show if it, he'll let you know, he'll educate you on the plans, and he'll let you know if this is something that would benefit you or not. And then that way you have all the information. Oh, okay. You want to talk? Okay. Could I, and I help him. Could I ask you a few questions? And so anyways, if of course that would be preferred that you do it that way. That way we split the case. Obviously, if I'm doing the majority of the work, there's going to be a bigger split on my side. But if you would like to, there's a form on the website, and I don't know if this is going to share because this is a different recording thing that I'm using right now. But on the website under it's not going to share it. Under the training center, if you go to docs and then under retirement, under the docs, there's a form called Retirement Questionnaire and Financial Evaluator. And that's all the questions you need to ask to get the information that I need to be able, because, and some people say, why do you need this information? Well, there's certain rules and regulations that we have to follow to making sure that we are recommending the correct product. So it's a financial form, and it's going to have some financial questions, and there will be questions on there like, are you married? What's your occupation? Stuff like that. as well. That way we can make sure that we have all the information correct. So this is going to be suitable for your situation before we recommend it. So that being said, remember, let me know if I can help you. If you have any questions, you need any guidance or special training, I'm here to help. Take care for now and look forward to visiting with you again.